Hi, welcome back. I hope everybody is duly refreshed and had the opportunity to grab a tea or a coffee. And welcome back to the final two sessions of this morning's event. Okay, so first of all, we've got a session where we're going to be focusing in on what I described at the beginning of the day as one of the big beasts that we're grappling with within the industry, and that's the topic of sustainability. As we get into the panel, first thing I'd like to do is thank State Street for very kindly sponsoring the session. And I would also just remind all of you, and it's great to see that people are now using the question functionality within the system, so please feel free to keep those questions coming for the group. So without further ado, I'd like to hand over to Kiara Horrigan from State Street, who's going to be looking after the next panel, and I will see you towards the end of this session. So Kiara, over to you.
Great. Thank you so much, Andy. It's great to be here. So good morning and welcome everybody to ISLA's panel on sustainability. We have a great lineup today, but first I'll just take a moment to introduce myself, set the scene before handing over to my colleagues to do the same. So my name is Kiara Horrigan and I co-chair ISLA's ESG or Sustainability Steering Committee. And in terms of my day job, I work for State Street's Regulatory, Industry and Government Affairs team based in London. And I focus primarily on coordinating the firm-wide response to sustainability-related policy issues and engaging across the different business lines that State Street has, as well as with our core regulators, politicians and policymakers from across the globe. So in terms of today's panel, as we know, sustainability was once far from the top of the agenda for many in financial services, but I think it's fair to say that this has all changed now. The awareness and the attitudes towards the world's environmental, social and governance challenges are now increasingly complex and an important initiative that will shape the future of not only the securities lending markets, but the broader financial services agenda for years to come. And the private sector must play a pivotal role in terms of redefining business as usual and is in fact in a very unique position to help incentivize businesses and companies transition, make a change, and be more accountable about their impact on the wider environment and society. So as I said, we have a fantastic panel with us here today, and I think it's about time that I hand over to them to introduce themselves. Perhaps, Crystal, if we could start with you.
Of course, thank you, Kiara. Good morning or afternoon, all, depending on your time zone. My name is Christelle Herbeau, and I work within the Sustainability Solutions team for global market activities at Société Générale. In a couple words, very briefly, our team aims at further developing the range of sustainable and positive solutions offered to clients. That is to say, solutions embedding ESG priorities across all asset classes for market activities.
Adam, perhaps you could introduce yourself.
Certainly. Good morning, everyone. So my name is Adam Jacobs-Dean and I work for the Alternative Investment Management Association. We're a trade association representing the hedge fund industry. And at AIMA, I'm responsible for our work on ESG and responsible investment. And we've seen in the last couple of years a huge groundswell of interest from members, driven not only by obviously the regulatory pressures that they're subject to, but also investor interest. So very pleased to be able to join the discussion today to add the investment management perspective to the discussion around sustainability.
Great. Ross, perhaps you next.
Yeah, sure. Thank you very much. Good morning, everyone. I'm Ross Beaumont. I'm responsible for clients that participate in the BNY Paribas Agency Securities Lending Program. The team I manage are primarily responsible for and monitor the program governance, performance and development of the product and service. We also support industry advocacy through best practice and through the work championed by ISLA and PASLA and the industry associations which we work. But ultimately, we're here to ensure that the product and service we offer is keeping pace with emerging trends and demand. And sustainability and sustainable investing is one of those key emerging drivers in today's financial markets. So look forward to getting into the weeds on this panel.
Perfect. And last but no means least, Ina.
Thanks, Kiara, and thanks everyone who's joined today. I'm Ina Budaraja, and I'm responsible for product and strategy for BNY Mellons Securities Finance business in EMEA. I'm responsible for ESG strategy across our markets lines of businesses globally. I also co-chair the ISLA ESG steering committee with Kiara, where we've been working together on, and with the ISLA team, Andy Dyson and Farah Mahmood, to address the evolution of our market through the lens of the sort of fast-moving sustainable agenda, and to really define the role of securities lending within that agenda, as well as looking at the challenges and the opportunities that it brings, and ultimately establishing best practices to support the market in developing practical solutions.
Brilliant. Thanks so much, guys. So perhaps, Christelle, if I could come to you first. We often hear the terms sustainable and responsible investment, but what does this really mean in the context of global markets financing activities?
Thank you, Kiara. And maybe before we dive into the subject, let me tell you a stat. As published in a recent report from the GSEA, Global Sustainable Investment Alliance, at the start of 2020, global sustainable investment reached $35.3 trillion USD in 5 major markets, which represent more than a third of total assets under management. These numbers, they cover varied approaches, and more precisely, in the context of this report, sustainable investment is defined as an investment approach that considers environmental, social, and governance factors in portfolio selection and management. As per this report, still, the most common sustainable investment strategy is ESG integration, which in short means the systematic and explicit inclusion by investment managers of ESG factors into financial analysis. One could also mention the following strategies: negative screening, corporate engagement and shareholder action, sustainability-themed investment, best-in-class screening, and others, which I won't further describe now in the interest of time. But in other words, ESG is a very large market with many different ways to use ESG factors. And now, if we wonder why investors consider ESG, to simplify in the interest of time again, we can identify 2 main drivers which can coexist. Doing good, which could be defined as aligning your portfolio with certain environmental and social objectives that you might have, and doing well, which could be defined as using financially material ESG criteria as a way to manage risks and or to enhance the long-term risk return of portfolios. More and more, the term responsible investing has gotten associated with the first of these 2 drivers. Until the recent past, when we read from clients or industry bodies about the ESG compatibility question being raised in the context of securities lending, it was rather, in fact, with a good business practices view. Generally, it starts with explaining usefulness of securities lending in general for the financial markets and good practices on voting, for instance, that could be agreed upon between stakeholders. As of course, the topic of shareholder stewardship through voting is a key one in the ESG investing space. This topic differs from the purely pragmatic financial materiality of ESG. Notably, ESG criteria could be used to screen the assets used to secure transactions for risk mitigation purposes, for instance. So in truth, any client conversation should start with listening and making sure we fully understand the client's objectives so that we can meet them.
Thanks very much, Christelle. And actually, it might be helpful at this point in time if you could perhaps provide our audience with a quick overview of the ESG landscape in the EU.
Indeed. Maybe a final word on the ESG regulatory landscape in Europe, as a lot has been happening on that front. To my knowledge, discussions have not yet focused on repo or securities lending, but a lot of the underlying principles can also apply to the repo or securities lending space, as we will discuss later. In the investing world, there is a will to bring transparency and to set standards. For that matter, the EU Sustainable Finance Disclosure Regulation, SFDR, is one of the key pieces of the EU Sustainable Finance Framework, which aims at reorienting capital towards more sustainable activities via more disclosures and classification of products. It notably impacts asset managers, insurers, among other financial market participants. There is also a will to norm sustainable activities via the setting of an EU taxonomy, that is to say a classification system, establishing a list of environmentally sustainable economic activities. And naturally, this context has triggered similar discussions in the repo and securities lending world. But we should keep in mind also that up until now, market participants and associations have not waited for regulators to establish norms to draft guidelines, as for instance when ICMA published the Green Bond Principles, which are voluntary guidelines. And it matters to be part of these discussions when it comes to global markets financing activities, to ensure as well we have in mind all client needs and business implications. So happy to do so today, keeping in mind, as you were saying, that the topic is complex and that the jury is still out.
Brilliant. Thank you so much, Christelle. So it's clear, and what strikes me is that in order to meet the goal of transitioning to a more sustainable future, an all hands on deck sort of approach is needed, securities finance included. So with that, Ross, Christelle, when you look at sustainability, what does this mean for you and your clients, and what are you doing in your respective firms to align this agenda with your securities lending businesses? Ina, perhaps maybe you could tell us a little bit about the work we've been doing specifically as part of ISLA.
Thanks, Kiara. Yeah, and I think it probably makes sense for me to answer the question in two distinct capacities, right? Firstly, as the co-chair of the ISLA steering group, and then from the BNY Mellons Securities Finance perspective, which I think we'll move to later in the session. So the ESG steering group is formed as a natural evolution of the previous ICSF, which was initially driven by the beneficial owners. And as ESG and the sustainable finance agenda have accelerated over the last 18 months, as Christelle mentioned, what's become very, very clear is that there's a need for the all hands on deck approach that you mentioned. So we've been working very hard through that steering group to create a collaborative and inclusive representation of the entire securities finance value chain end to end, really to ensure we're properly representing the entirety of the ISLA membership, of which there are currently around 170 members. Therefore, we're ideally placed to take on the evolution of ESG for the securities finance business, and we're specifically addressing the topics which our members have told us are important to them. So, taking those firstly as the sort of overarching goal of the steering group, we're defining the role of securities lending in the context of the sustainable agenda, i.e., what can we do as an industry to make markets more efficient and really be an agent for change to facilitate that transition to sustainability on the broader scale. And that's involved advocacy and market education on the compatibility of ESG and lending, highlighting the importance of lending in the capital markets infrastructure, for market integrity, price discovery and liquidity, and going further, highlighting potential for the product to act as a market safeguard by increasing transparency on ESG claims and perhaps even exposing greenwashing going forward. And then separately, we've looked at the specific components of securities lending to address market concerns on practical issues, which Christelle alluded to, such as collateral, i.e. to what extent should non-cash collateral align with ESG investing policies, Should collateral embed the same ESG restrictions on as the long portfolio? Or should a wider ESG approach be taken for collateral, for better risk management, and to protect market liquidity ultimately? Also the question of should pledged collateral be treated differently to title transferred collateral when it comes to ESG application? And given the absence of specific regulatory guidance on collateral, we're seeing that essentially a values-based responsible investment strategy of an asset owner is generally not contemplating collateral separately, and therefore, at times a rather blunt approach is being applied by default, which has the potential to reduce market liquidity and collateral velocity if it's applied at scale. And that could create a pool of stranded assets potentially, rather than supporting the orderly transition to a sustainable economy, which is obviously needed. So we're engaging with policymakers on those potential unintended consequences of recent ESG regulations, where I think there is some need for guidance on the treatment of collateral. That would certainly be helpful to this industry. Another priority for members is voting, the growing focus on stewardship, with increased expectations on asset owners to demonstrate engagement and active ownership over divestment and negative exclusion, particularly where ESG labelling bodies and net zero alliances, for example, prescribe active voting policies, really raising the question, how do these commitments reconcile with securities lending, and what should a thoughtful recall policy look like? As an agent lender, we're obviously developing solutions to support our clients and their ESG voting requirements in parallel. But we're also advocating through the ISLA group for policymakers and the labelling bodies to consider the full scope of asset owner fiduciary duties. So really to encourage lenders to make balanced, data-driven decisions on the materiality and the impact of a vote versus the duty to generate additional alpha for their underlying investors. And that's, I think, a tension that is only going to increase unless there is some guidance and asset owners are able to commit to voluntary guidelines like the NGFS, the IIGCC. We're seeing the Net Zero Assets Managers Alliance and One Planet Sovereign Wealth Fund Alliance, all prescribing significant engagement duties. So really, how do we support those? And these are the key areas of work by the steering group. And we're currently drafting papers on collateral and on voting, following the white paper that was drafted in collaboration with Allen and Overy in March on framing securities lending for the sustainable era, which we're using in engagement with regulators, with policymakers and the labelling bodies. And I should add also that we recently met with the UNIPRI, who are drafting their own house view on securities lending, and will be continuing that dialogue, which was actually very positive in terms of supporting the role of securities lending in the market. And most recently, we formed an alliance with other global trade associations, PASLA, RMA, CASLA, SASLA, and it's an alliance that's open to all those that want to join, to collaborate on best practice with the regional nuances of course, and to share common narrative on advocacy and work together on market education. So really taking a global approach to promoting securities lending as an enabler of sustainable finance and driving impact. And to conclude, I'd say we've really moved past the old debate now of whether securities lending is compatible with ESG. Yes, it is, and I think that's well recognised. It's recognised by regulators, by the PRI and the labelling bodies. And we've also established that there are high-level principles that can be applied to your lending programme to align with ESG requirements. So what is needed now as the regulatory landscape continues to take shape are flexible solutions from service providers which really take account of the ESG journey as it's evolving and which will change the way that asset owners engage with securities lending going forward. And Kiara, that's my not so short answer. I mean, I'll dig into the sort of BNY Mellon approach as we discuss.
Thank you very much, Ina. And I mean, it's clear that ISLA's done a lot of good work, and I'm glad we're at the forefront of this. Perhaps, Ross, you could maybe provide some insights from BNP Paribas perspective.
Yeah, sure. I mean, just taking back to August earlier this year, just a couple of months ago, I think just reminding everyone that the IPCC, the Intergovernmental Panel on Climate Change report came out. That was hailed as a bit of a game changer in terms of the human role in the climate crisis, and they classified it as unequivocal evidence. So ESG is clearly a strong trend influencing investment behavior. So it's client agnostic. So already we've started to see ESG investment policies and principles being set up and established across our client base, not only just for the securities lending products, but all products. So these are overarching principles of investment behavior and trends. So ESG is a long-term strategic ambition and a strategic strategy. So therefore, you're looking at balancing the long-term needs and desires of such a strategy with perhaps some of the short-term demands that are required for revenue generation out of the capital markets. So if you look at what BNP Paribas specifically has been doing, we are part of we joined the Net Zero Banking Alliance in April earlier this year. That was the UN Environmental Programme for Finance Initiative. We've been financing and aligning our investment strategies across the group with strong ESG commitments to those alliances. That alliance contributes and aims at targeting net zero by 2050, with a number of interim targets that take place on that pathway to 2050. That alliance is aligned with the UN Sustainability Development Goals as well. So that's a clear and prominent one at the forefront of the industry. Carbon neutral and carbon neutrality, which has been obviously a trend and a theme over the years, it shouldn't be mistaken from net zero, because the two are fundamentally different. One being used to effectively get a net zero position from your entire business. The other one being used, carbon neutrality, to utilize offset programs to enable you to become carbon neutral. So there's a difference there. BNP Paribas has been measuring its footprint, its carbon footprint, since 2012, and it's been carbon neutral since 2017. So as a business, we are kind of certainly moving forward, and the ESG themes run true within everything we do. Specifically to the business that we manage as well, just across the group, we've recently launched the results of our third ESG survey. So that's a survey of 356 institutional investors across 19 countries, and we're starting to see some increasing trends as you go through the years and compare from the data we've been compiling from the previous years. So two key elements of that: 22% of the respondents within the survey started to integrate ESG tenants into 75% of their portfolios. But critically, brand and reputation has now overtaken returns as the main ESG driver. And that I think is quite a fundamental shift in terms of its profile it's getting across the investment universe. If you look at ESG specifically for securities lending, I think people need to accept that it's more than just a rebranding and repackaging of the existing set of options available within a lending program. So borrower collateral selection, proxy voting, securities exclusion lists. This is a longer-term strategy that should be applied and based on the primary investments of the underlying beneficial owner and asset manager, and then overlaid onto the tenants that apply to a securities lending program. So the industry needs to solidify its importance. I think, as Ina mentioned, I think the argument about can ESG and securities lending coexist, I think that's already been answered. But I think we certainly need to drive our importance within the capital markets infrastructure so we can operate, grow and thrive alongside the sustainable investment principles that our underlying beneficial owners adhere to. Finally, I would say client engagement, industry engagement with ISLA, vendor utility management, all the services and participants within the securities lending market do need to come together. We need to accelerate our understanding of the trends that will shape the product and what it will look like in the future. So vocalizing and sharing views, I think, is going to be critical over the next 12 months.
Great, thank you, Ross. And Christelle, maybe I could pose the same question back to you.
Thank you. I also see two questions in your question. More generally, what sustainability means for both the bank and the clients is first being a sustainable counterparty the clients want to work with, and as a consequence, be committed as a bank. And among the ambitious targets the bank had set itself, you can find, for instance, the target to achieve carbon neutrality in banking portfolios by 2050, or even the objective to completely exit from the coal sector by 2040. Second, but not the least, what it means as well is to answer clients' needs by providing services such as research, but also a product offering that answers their own specific needs, including their ESG priorities. As for the second question, what we are doing to align this agenda with our securities lending businesses, if we answer from a sustainability product developer point of view, what we try to achieve is to build a relevant financing solutions offering that embed ESG criteria. And there are several possibilities when it comes to repo or securities lending products. Let me explain a couple. So first, one natural and obvious way to embed clients' own ESG priorities is to align their repo securities lending businesses with their existing internal ESG guidelines they might already have on the investment space. And by this, we mean screening the collateral schedule of transaction with ESG criteria. As an example, it could mean considering as ineligible companies that have a certain percentage of their revenues derived from a specific activity. In any case, any communication on such transactions should remain proportionate to avoid over-portraying the impact of ESG filters, transparency being key. Then let me describe another possibility, sustainability-linked structures. Such structures inspire from what already exists, such as sustainability-linked bonds and sustainability-linked loans, where the issuer or the borrower, respectively, commits to reaching an ambitious performance target linked to one or several sustainability KPIs in line with the client's CSR strategy. One very standard example of KPI is the carbon footprint of the counterparty. The same would apply to repo or securities lending transactions, where an incentive mechanism materialized at a spread over the traded level, for instance, would be linked to the achievement of the extra financial objective by the counterparty of the trade. Third, and I will stop there, a client asked us as well to look at another possible solution where an equivalent amount of the cash raised through the transaction could be used to finance or refinance green and or social projects, as sustainable bonds would do. In short, there are many possibilities to embed some ESG priorities in repo or securities lending businesses. And earlier this year, ICMA published a document where they share their views on possible intersection between sustainable finance and the repo market, for that matter. And some of these possibilities are mentioned. And again, to conclude, transparency is key because portraying the solution accurately is the number one way to build sustainable trust with clients. Back
Great.
to you, Kiara.
Thank you so much, Christelle. Adam, perhaps it's a good point in time to bring you in here, and obviously you can offer a much broader perspective of the alternative investment community. And securities lending is obviously a key process that enables short selling, core activity of your membership base. Can you tell us a little bit about the role of short selling in the context of responsible investment and what it means for your members, please?
Sure. Well, it's probably worth sort of acknowledging upfront that short selling can be one of those more emotive topics, particularly when it comes to dealing with regulators. If I think back to last year, I spent a lot of my time talking about short selling bans and the impact they were having on the market in terms of liquidity, price formation, and the harm that they were causing, essentially. But in the context of responsible investment, we like to think of short selling actually as a differentiator when it comes to ESG and responsible investment. So if you take the example of a buy and hold equities investment strategy. For any ESG concerns that you might have, obviously you can go down the engagement and stewardship route, and we've heard from Ina and Christelle about some of the practicalities associated with that. But ultimately, you might or might not be successful in terms of engagement. You are one shareholder among many potentially. Or ultimately, you can sell out of a position if you have ESG concerns that really are ultimately overriding in terms of your analysis. And, we've spoken as well about negative screening. So it might be something where you just say we're going to screen out certain investments from the investment universe. But actually, if you look at short selling and you can use short selling as an investment technique, suddenly you have a completely new tool to either limit your exposure to certain issuers or indeed certain sectors on the basis of ESG concerns. We tend to use the example in our work of carbon risk. So if you're interested in carbon risk and looking at the potential, for example, for a carbon tax, and you make the assumption that the carbon tax will be ultimately more detrimental from a securities value point of view for high emitting sectors, then you could say we'll use short selling as a way to essentially limit our exposure to carbon risk at the portfolio level. So short selling suddenly from that point of view becomes an ESG tool. You could also think of it in terms of impact more broadly actually as well, rather than just risk management, because if you consider that multiple actors might be shorting a particular issuer because of ESG concerns, then collectively that could actually be the source of pressure on their cost of capital that leads them to put in place changes that will ultimately be good from an ESG perspective. And in a similar vein, you could also look at individual activist campaigns, like the example of Wirecard, where you have investors actually seeking to shine a light on ESG, in that case G, issues that the rest of the market might have been blinded to, essentially. So there's quite a lot of interesting sort of observations you can make around short selling and its role in the context of responsible investment. But what I would say actually is it goes to a broader point that there is a tendency, certainly among some policymakers, when we talk about responsible investment, to basically take the template of what exists for the long only, buy and hold, big corporate issuer investment sort of equities mindset, and try and translate that to other asset classes or investment techniques without actually thinking through the differences in terms of how investment managers trade. So the point for us ultimately is there is no one size fits all to responsible investment, and that's important when it comes to talking about the design of rules.
Great, thanks, Adam. And actually, Christelle mentioned SFDR earlier, the Sustainable Finance Disclosures Regulation. Obviously, this is the first big piece of EU legislation coming out, and notably would capture, I believe, quite a large amount of your membership base. Are you seeing any challenges in terms of legislative interpretation or application with regards to SFDR?
It is a given that regulation always prompts debate, and there are always areas of uncertainty, and that's good because it keeps me in a job. But I do think SFDR overall seems to be associated with far more interpretational difficulties than most of the things we've been working on in recent years. And we continue to have member discussions about what the rules mean, even at this point. And just to give you a bit of a flavour of that, the standout issues have tended to be how the rules operate on an extraterritorial basis. Obviously, for many of our members, where they have a management company based outside of the EU and they're distributing their product to European investors, the immediate question is which bits of SFDR do we need to comply with? And at this stage, there isn't consensus among even the legal community when it comes to answering that question for investment managers. And then the other key issue has tended to be at the level of SFDR's product boundaries. So by way of background, SFDR essentially tiers products according to the greenness, if I can put it that way, with differentiated disclosure rules depending on where a product lands on that scale. So you have mainstream products, what we refer to as Article 6, products that promote E or S characteristics. So you could think there of products that have a sort of meaningful degree of ESG integration into them, so Article 8 products, and then ultimately products that have as their objective sustainable investment, so more impact oriented products, Article 9 products. You've got these 3 buckets basically, and navigating the boundaries between those product categories in practice is tricky. So we've spoken about screening earlier. When does a screen become significant enough and limiting enough that your product has ceased to be a mainstream product with a really generic screen to actually being something that is promoting environmental or social characteristics? Obviously, most investment managers have baseline screens that they don't, for example, invest in arms manufacture, but actually day to day, that's probably not a major sort of restriction on the investment strategy. So there's those kind of practical questions, but it's an interesting one because it's one that ceased to be just a question of compliance with the regulation and getting the rules right, and that has actually become much more commercial, because increasingly these product designations are almost being treated as labels. So you will hear people talking about Article 8 and Article 9 in a completely sort of shorthand way for a product that is perceived to do more from the point of view of sustainability, and investors are interested in products that can position themselves in that way. So there's definitely a new kind of commercial pressure coming to bear on investment managers that is encouraging them to think about how they design products, and actually the regulation is becoming in some ways a proxy for labels that might not exist or be available today. So the SFDR discussion is very much alive and well.
Thanks, Adam. Ross, perhaps specifically with regards to the securities lending business, has ISLA done any work around SFDR application for market participants? And maybe you could start.
Yeah, of course. We did a lot of work through the ISLA group on determining for the market with counsel whether SFDR, catches securities lending as a product or not. And I think we've determined that inherently securities lending isn't, a product for the purposes of Article 6, 8 and 9, which Adam just mentioned. But also, we looked at, echoing the points Adam made, we looked at those product boundaries, and the question of when does negative screening, for example, tip you into one of those categories, which are becoming effectively labels in the market. And I think the determination was around portfolio management. That would trigger you into SFDR. If you're not a portfolio manager, you would be outside at this current time. And that'll depend on your model, your category investment strategy, for example, which might bring you in scope of portfolio management. But I think it's also worth just mentioning that, on the point about lack of clarity on the articles and the labels, ESMA have responded to a recent Q&A where they've indicated perhaps threshold, not giving a threshold amount, but that there may be thresholds which that will then bring you in scope of 8 or 9, and there may be some element of sitting outside of the threshold. So collateral, for example, may constitute a risk management tool or a liquidity tool, which wouldn't have to embed ESG in exactly the same manner as your core portfolio. Not to say it wouldn't embed sustainability, of course it would, but it may be to a broader degree. So I think that's something that we need to watch as an industry.
Thank you, Ina. Ross?
Yes, I think Adam and Ina have covered that point pretty well in terms of the ambiguity that's fallen on us from the lack of clarity underneath the SFDR regulation, in particular in the appropriateness of Article 8 and Article 9. ISLA worked with Allen & Overy before the implementation and produced a paper, a helpful guide that helps kind of market participants look at the challenges with the with interpretation of where the product sits underneath these two articles. And even though they don't necessarily promote the ESG initiatives, and it's not, securities lending is not seen typically as having the primary objective of sustainable investing. There are elements of what we can do around screening, etc., that will point the product more towards either Article 8 or Article 9. So I think there is certainly plenty of work to do. But of course, there's always transparency as well. There's already transparency, so let's not forget. Securities financing is probably now one of the most regulated investment practices on the planet, it seems, especially if you look back 10, 15 years ago. So I think it's an efficient portfolio management technique. It provides a lot of transparency. I think certainly under SFDR, the daily reporting requirements, the regulators have all the movements of the loan transactions, etc. So there's a lot of transparency in the business, and I think we just need to fine tune how we want. In the absence of guidance from the regulator, we need to fine tune exactly how we're going to augment our business and product to align it best with what our clients are going to want, and also with the goals of either Article 8 or Article 9. You also have to take into consideration that the product itself, there's an awful lot of not just transparency, but it creates exceptional strong liquidity in the secondary market, and it allows, as Adam alluded to, directional short coverage as well, which can highlight poorly governed corporations, and could actually also assist in the acceleration towards a shift to a more sustainable economy. So having that ability through the securities financing products, I think, could certainly aid the movement and the transition to a more sustainable economy. So I think while the industry waits for that guidance, we need to think collectively about the measures that we can take in overarching governance around the product and service, and how we can change that more in line to what our clients are looking for. And I think the best practices and the sustainable securities lending practices that ISLA are promoting, I think, are certainly providing the baseline for that argument.
Perfect, thank you, Ross. So, it's quite clear then that securities lending has not been specifically considered within the core pieces of ESG legislation coming out of the EU. And in the absence of that regulatory guidance, we heard a little bit just now from Ross in terms of, what the market should be doing and could be doing. But Christelle, maybe we can start with you. What are you doing to incorporate ESG considerations into products, particularly as a sustainability-orientated role? It must be quite challenging.
Indeed, we are noticing that some clients are asking for the screening of their collateral schedules based on ESG criteria, more or less significantly. And in our opinion, and to simplify again in the interest of time, there can be two drivers to that. It could be because the clients want the companies to change, the objective being to push these companies towards better ESG practices. It's already the case in the investing world, and it sounds natural that clients seek to align financing activities. Although exclusion is usually a last resort when influence via stewardship efforts have failed. A second possible driver would be for risk mitigation purposes. We can assume that clients believe the ESG risks are relevant enough, meaning financially material, to be taken into consideration in their risk management, and thus exclude some issuers based on that assessment. More regulatory developments are yet to come, and in the meantime, one can create interim frameworks internally that inspire from existing regulations, even though these did not aim to address explicitly the repo or securities lending businesses, but for which the underlying principles could also apply to this space, and similarly inspire from the existing published voluntary guidelines on other asset classes, such as ICMA's green bond or social bonds principles, when looking at developing solutions where an equivalent amount of the cash raised through the financing transaction, for instance, is used to finance or refinance green and or social projects. Such frameworks allow to have an internal standard for such financing solutions, to be adjusted, of course, once regulations evolve. Then, operationally speaking, what hurdles could we face when trying to concretely embed each client's own ESG priority in financing transactions? Clearly, we need to be able to customize based on clients' own ESG priorities and be operationally flexible. So for the so-called ESG screen solution, it translates into being able to customize the screening of collateral schedule of transactions. One can rely on the composition of some well-known benchmark ESG indices, so relying both on the criteria of the index provider and the data from an external data provider. One can prefer to screen the assets used to secure the transaction with their own guidelines and their in-house ESG research, more bespoke offering, or rely on an ESG screen collateral schedule the bank might have created as a flagship offer on a specific starting universe. In short, we need to be ready both in terms of internal guidelines to assess the significance of the screening and to be ready operationally to address clients' specific guidelines. Finally, maybe, we know that so-called ESG products are only a piece, even though iconic, of the transition. We must be able to embed ESG in client discussions and solutions, even when these solutions are not marketed as ESG. It's similar to the fund space, where a very large number of funds integrate financially material ESG consideration, yet they're not called or marketed as ESG.
Thank you, Christelle. How is BNY Mellon proceeding in the absence of explicit regulatory guidance?
I would agree with much of Christelle's solutions. I mean, we're engaging proactively with our clients, and I think engagement is absolutely key. Ensuring that we're understanding our clients' ESG policies and encouraging them also to connect internally on their side to really ensure that their securities lending business is reflecting their enterprise responsible investing strategy, which isn't necessarily the case yet for all asset owners. We're taking a flexible approach to our product development and obviously investing in ESG solutions related to collateral, to proxy voting and cash collateral reinvestment. And I think on the reinvestment side, there is opportunity to take a more impact-driven approach. We've worked collaboratively across our markets businesses, so building a cohesive roadmap for ESG client solutions across lines of business, which is essentially centered on providing clients with transparency, with a consistent data approach, so they can really answer the question fundamentally: what's the impact of their investment? How can they measure that impact in a reliable and comparable way? But at the same time, we recognise that there is a plethora of ESG regulation coming down the line, and even existing regulation is likely to change. So we need to develop very flexible solutions. So collateral will be modified to align with ESG requirements, as will voting, and we're seeing massive increase in engagement. But we need to prepare for all eventualities so our product can evolve. And as a starting point, obviously, we are using ESG scores for issuers on our approval lists, and have various plans to build out dashboards for clients so they can evaluate their product from an ESG perspective.
Thanks, Ina. And Ross, I don't know whether you had anything to add to that.
Yeah, just very quickly. I mean, I agree with everything that's been said so far. We've spoken about advocacy. We've spoken about engaging with your clients. I think they're a given. We're now at a stage where I think we just need to, I think the question is, how do we encourage the conversation without disrupting the existing revenue streams? I think that's a big one for everyone at the moment in the market. And I think the answer to that is going to be a pragmatic and gradual approach. This is a transitional, longer term strategy for the business and the market, and we need to adopt a longer term strategy approach for that. We've spoken a little bit about the types of collateral and the collateral screening. Naturally, you may consider the fact that a client will automatically adapt their lendable assets to already be aligned with their investment strategy and their ESG strategy. So collateral is a key element of the conversation. The question there, could pledge collateral be something that clients would now consider in greater numbers, primarily because you could argue that under a pledge there's no title transfer. So could the fact that having not that title transfer in place, the collateral that's provided or pledged has less of a bearing and an importance on the reporting that the client does. These are all questions that still need to be answered. Specifically for us, we are already screening collateral portfolios. We've got a number of proof of concepts running at the moment. We're working with internal and external providers, and we're already creating natural language rules-based reporting that really compares the collateral and the screening of the collateral both to the UN Sustainable Development Goals, but also to an ESG report that scores according to the client strategy. So I think they're the main things that we're driving at the moment.
Perfect, thank you, Ross. And Adam, just quickly going back to something you said earlier around the fact that firms are turning to global frameworks like the UN-backed PRI. Why do you think corporates are doing that? And also, I understand that AIMA are doing some work with the UNIPRI. Could you tell us a little bit about that too, to the extent that you're able to?
Yeah, sure. So, I mean, PRI does have a standout position in terms of being one of the standard setters that people look to. There's a lot of investor scrutiny of whether investment managers are PRI signatories, so pressure comes from that direction as well. So we do have many members who are PRI signatory, not necessarily sort of a uniform approach, but it is basically an important reference point for practice in this area. So we've been working with them on short selling, so we're looking to produce a paper, and they're also at the moment updating their due diligence questionnaire that they have in respect of hedge funds, responsible investment approaches. So there'll be an update to that document. But it's probably just worth making the point that any external standards inevitably come with their limitations, and that might be a limitation in terms of how much they get into the weeds of something that we might passionately care about, but from a sort of global standard setting is actually just a tiny bit of the overall ESG landscape. So that is often the frustration for our members, is that some of the external standards out there don't necessarily get into the weeds of how they trade and what they trade, making it harder to say that you're aligned to a sort of consensus approach in certain areas.
Thanks, Adam. And just in interest of time, I think we might have time for one more question, which I'm going to put to all of the panelists. And I think it's quite clear that there are sustainability-related conversations being undertaken across the investment chain. And obviously your clients are quite vast in terms of asset managers, insurance companies, sovereign wealth funds. And there's a sense that these are all independently creating their own sustainability policies, and that might be somewhat removed from the sight of securities lending participants. With that in mind, I'd be very interested to know what each of the panelists think the next 3 to 5 years holds in terms of sustainable finance and gender and impact to your specific business frameworks. And Adam, since obviously you're representing the alternative investment community, maybe you could go first and provide the 3 to 5 year outlook from your perspective.
Sure. So I think the data. So our members constantly cite the challenges in terms of availability of corporate and issuer data about their approach to sustainability. And I think that will continue to be evolution on that front in terms of new disclosure requirements for corporates going live, and also building pressure for them to provide more of the information that investment managers actually need to be able to integrate ESG considerations. And then alongside that, I think there will be a continuing advancement in terms of the sophistication of tools and approaches that investment managers can actually use when it comes to making use of that data and building a responsible investment framework that is meaningful and actually ultimately potentially achieves impact as well.
Thanks, Adam. Ross, maybe you could provide your views.
Yeah, certainly. Just to wrap up, I guess, greater level of client engagement is going to be critical for the next 3 to 5 years. I think you're going to see an increase in the level of standardization across the product and the industry. That's through the advocacy efforts of ISLA and best practice engagement. That's going to be critical. We may also see a bit of a shift in opportunities. So, a quicker shift away from the historical cross-border revenue streams that people have enjoyed over the years. So I think, trade structures may change. And you've also got, and I think maybe you may have touched on it just earlier, you've got the UMR, the uncleared margin rules regulation that comes into effect. Was already in effect for phases 1 to 4, but we have 5 and 6. So already work being done on that by ISLA to calculate the potential impact of that on the securities lending industry itself. So regulatory reporting requirements are going to be needed, and I think some of those changes could certainly impact where the market is going. But ultimately, it's going to be down to engagement. It's going to be technology, and it's going to be working collaboratively to try and harmonise and standardise the product for our clients.
Thanks, Ross. And Christelle, maybe in the interest of time, a quick word from you each.
Yes, I'll try to make it brief. And again, as we were saying, ESG means different things to many people. So we need to be able to customize based on clients' own ESG priorities and operationally flexible. More generally, our ability to support our clients through their own ESG roadmaps across the entire value chain is what will make the difference. And this ability is needed whether we are looking at developing solutions in the investing space, hedging space, or financing space. But again, the products are an iconic part of what we can provide as a bank, and more generally, what's key for the bank is to raise awareness internally and support clients in their own ESG transition. And to conclude, the fact that the industry is mobilizing and is trying to define standards is a great thing. And for that matter, several working groups are emerging on these topics, and it's really important that the initiatives be coordinated, that the dialogue should be organized to avoid the multiplication of standards and gather all relevant approaches. I would add it's not only about setting standards pertaining to products' characteristics, it's also about setting standards for product transparency. Finally, I would say that there are still moving pieces and that we all need to get our feet wet to start building these common standards, which should encompass each possible ESG objective from clients. It's only the beginning of the journey.
Thanks, Christelle. And Ina, the final word from you, please.
Yeah, very quickly, agree with all of the above. I think we'll see much greater scrutiny on ESG by regulators, greater shareholder action, and a rise in shareholder activism. I think there'll be global ESG reporting requirements which become embedded into the BAU, which will transform our product governance, much in the way that MiFID II did. I think data and transparency will be key, as mentioned. And I think 5 years' time, we'll have moved on from looking at how can we adapt to ESG needs to really launching the next generation products. How can we drive impact, particularly through cash reinvestment, for example, and engagement, to support the urgency of the climate finance agenda from the 2030 to 2050 time horizon. So I think a lot to follow.
Perfect. Thank you, Ina. So I just really want to thank all of our panelists today for their fantastic insight. It's been really, really informative. It's crucial now. It seems that securities lending participants must engage in the broader debate and ensure the product is seen as an enabler towards the transition. I do apologise, we didn't manage to get through all of the questions today. So if you do have any, please do send them on to Farah Mahmood and we can follow up afterwards offline.